Welcome to our Outlook 2015 event. Before I start the formal presentation in the book, I want to talk very briefly about what's happened in the last 6 or 7 weeks since the market started a bit of a decline on September the 3rd. And from September the 3rd till October the 16th, the TSX actually at its worst fell 13%. That's a correction. It's not unexpected, it's not unusual, but it's not pleasant either. But those of you who were here last year will remember we talked about the concept of upside capture and downside captures. Everybody remember that? Yeah, of course. The idea is that when the market goes up 10%, if you are capturing 100% of that, then our portfolios would go up 10%. And if the market went down 10% and we were capturing 100% of the bad times, we would also go down 10%. So I can now tell you that from January the 1st until August 29th, which the first 8 months of the year, the Toronto Stock Exchange had a tremendous run. It was up 16.97%. That's a lot. Our client equity portfolios, that is to say not the bond part, but just the equity part, were up 14.43% in that time period. We captured 85% of the upside. Now, I always tell people that we will seldom capture 100% of the upside because we don't buy the little speculative stocks. We don't buy the junior gold miner that goes from $2 to $20 in a heartbeat. And the reason we don't do that is because we're more concerned with downside capture. So from August 29th until the bottom of the market, until today, from August 29th until today, the TSX went down 8.09%. That's even after the recovery of the last 4 days. Our client portfolios went down 2.38%. In other words, we captured 29% of the downside. So this is our strategy in life. We capture 85% of the upside, but only 29% of the downside. Those are the actual numbers. And if you got your September 30th report in the mail, how many people got their September 30th report? Almost everybody. You will have seen that as of September 30th, you were doing quite well indeed. I can now tell you that as of the close today, our average equity portfolio for the month of October is down 0.19%. In other words, our clients have not been much affected by this correction. I hope I've set everybody's mind at ease. We're now going to turn to our booklet.
Thank you for that.
You're welcome. And our theme this year is based on an antithesis, a bifurcation, a division in the fortunes of individuals and corporations. Individuals have done quite badly coming out of the recession, but corporations have done very well indeed. And I want to talk about why that is so and what the implications are for us. So if you turn to page 2, which has a rather large and complicated looking graph on it, I'm going to give you 5 reasons why the recovery in the North American economies has been so slow and why families and individuals have done so badly coming out of this recession. So if you look at this rather large graph, I want to draw your attention to the thick red line that goes down to near the bottom of the chart and then drifts up to the upper right-hand corner. What this graph shows is the percentage of Americans who lost jobs during the recession, and you can see that in excess of 6% of all jobs in the US economy disappeared during the recession, and it shows how long it took for those jobs to come back. When that red line crosses the 0 line near the top of the chart, it's a full 75 months, 6.25 years after the start of the recession until there were as many people working in the United States as there were before the recession. The lines in other colors in the middle of the graph show the experience in all the other recessions in the post-Second World War period. And what you can see is that no other recession had the depth of job losses, nor anything like that length of time for jobs to be recovered. This was truly a devastating recession for working people, and it took 6.25 years for those jobs to return, basically until now. So, you might say, well, fine, everything's now back to normal. Everybody who wasn't working is now working again. Everything is fine. And that would be true if the world were a static place. But we know the world is not static, and in particular, economies and nations grow. And if you look at the blue graph at the top of the next page, what you will see is that, in fact, the population of the United States grew by 15.6 million people during that 75 months. In other words, the same number of people are working as were working before the recession, but there's 15.6 more millions of people, clearly, who aren't working. And normally we would expect a good 10 or 12 million of those people to be working in the economy. And that's one of the reasons the recovery has been so slow. There's simply been a jobless recovery. And particularly hard hit in the United States, if you look at the graph on the bottom of the page, are what we would call people in the prime working age. If you look at the red line, these are people between 25 and 55 years of old. And when I call them prime, I'm recognizing that I'm above that age category, as are several other people in the room. But those are the people who typically form households, have children, buy houses and durable goods. And if they're not working, it's bad news. And what you can see is the light blue area on the right of that graph, that population of people working fell very sharply in the recession, from 80% to 75%, and has not recovered all the way since then. It's edged up, but there are still something like 5 million people in that key core of life age group who are not working. Truly a jobless recovery, and one of the reasons that the recovery has been so slow. Now, a logical person would ask at this point, why aren't those people working? There's a couple reasons. If you look at the graph on the top of page 4, one of the reasons has to do with technology, and particularly the technology of automation. The graph on the top of page 4, the blue lines show the growth of industrial robots. Now, industrial robots don't look like R2-D2. Industrial robots are things that weld cars and paint things. And in a real sense, when you go to a parking lot and you do pay and display, you're dealing with an industrial robot that's replaced a human being. And you can see that the number of industrial robots has grown inexorably, and that the number of people employed in manufacturing has not, coincidentally, at least in my view, fallen at the same time. You can see that orangey line going downhill, good times and bad times, as jobs are replaced by automatons. This is a trend that I think is not going to change. Another reason why there are fewer people working, even though the population has expanded, has to do with demographics. Demographics are the inexorable, the unchangeable, the inevitable factor in every economy. And as you can see, in the North American economy, as has happened in Japan before us, as is happening in China right now, and is happening particularly in Italy and France, people are getting older, having fewer children, and living longer. And I draw your attention particularly to the green line at the bottom of the graph on the bottom of page 4. Those are people 85 years old and older. And what you can see is that before 1960, that line is invisible. Simply put, 50 years ago, not that many people lived to be over 85. Advances in medical care, particularly in the treatment of cancer and the treatment of heart disease and stroke, has led to an ever-increasing cohort of people over 85 years of age. And you can see that now in 2014, there's something like 8 million people over 85 years of age in the United States, and that's projected to grow to over 25 million people. Those people, by definition, are usually not heavily employed in the workforce. And finally, my last comment on this, a lot of people are working part-time involuntarily. If you look at the graph on the top of page 5, this is a graph of people working part-time for economic reasons. In other words, not by choice. Many people choose to work part-time for various reasons, but what you can see is that during the recession, the number of people working part-time absolutely skyrocketed and hasn't come down to anywhere near the level that it was before the recession. So reason number one, the recovery has been so slow: fewer people working, more people working part-time, people being replaced by machines, and people getting older. The second reason the recovery has been slow is that the people who are working aren't making as much money as they should be. Now, what does should mean? Should is a judgmental word, of course. I draw your attention to the graph on the bottom of page 5, which is perhaps one of the most important graphs in the presentation tonight. This shows real median income. Real income means adjusted for inflation of households in the United States. And median means the household in the middle, the one that has 50% of the households above it and 50% of the households beneath it. And I want you to look at this carefully, because if you look, what you will see is that around 1960 or so, the real median income per household in the United States was about $50,000 per family. And here we are 53 years later, and the real median income is 4% higher, 50 years later. When people say that workers have not had a raise, I'm not being an Olivia Chow or a Thomas Mulcair supporter when I tell you they're right. Those are the facts. And if you look even more pointedly at 1998, when the median household in the United States had an income of $56,900, it becomes clear why the recession is so slow. Median household income in the United States has gone down 10%. When people don't have money, they don't spend money. And when they don't spend money, it's hard for the economy to grow. So that's reason number two. Now, this is not a short-term trend, nor is it something that just happened. This is a graph we had in the presentation last year, and it's so important I put it in again this year. The share of the economy that goes to wages is shown in the graph on the top of page 6. And what you can see is that the share of the economy going to labor has been shrinking ever since about 1980. It's been going downhill faster and faster, and in a minute we'll talk about where that money has gone, if not to wages. So, number two, people aren't making as much money for working, therefore can't spend money. Number three, the reason the economy is not spending is that Americans in particular got scared to death by the recession. And when people got scared, they changed their behavior. And in particular, they changed their behavior by not incurring new debt, but instead by paying off debt. And by not buying new houses with 3% down, and not buying new cars with nothing down, or appliances, or TVs, or carpets, or draperies, they stopped spending money because they were scared. And if you look at the graph on the bottom of page 6, what you will see, the red line is basically the percentage of debt held by families. You will see that in the recession and thereafter, people started paying down their debt very quickly because they were scared instead of buying stuff. That's the third reason. And that's reflected in the chart on the top of page 7, which shows you sales of new homes in the United States. Now, those of you who have been coming to this presentation for years are well familiar with this graph. You know that the proximate cause of the recession in the United States was the spike in houses that you see in this graph from 600,000 units a year, the normal rate of new home construction, to $1.4 million, 1.4 million houses a year at the peak of the idiocy, when people were given loans with no income and no assets and no jobs. Those were called ninja loans. No income, no job, no assets. And of course, that came to a very bad end. But you can see that after the housing market collapsed, and you can see that line just goes off a cliff, here we are 6 years later, and housing starts are still only 2/3 of the normal level of 600,000 a year, only 400,000 going on right now. So this is partly because people are scared and partly because banks are scared to lend to them, but there is not as much money being spent on durable goods. That's the third reason. The fourth reason the recovery has been slow is that too much money has gone to too few people. You all remember the Occupy protests of a couple summers ago. You've been reading in the newspapers and magazines and hearing on TV about increasing inequality in economies. The graph on the bottom of this page, on the bottom of page 7, shows you who has been the winners and who have been the losers in the American economy. If you look at the purple line, which is the top 5% of all households, you can see that those households' income has gone from $160,000 a year in 1990 to $196,000, about a 20% increase in the last 25 years. But if you look at the blue line, the 50th or median household that we talked about before, again, these households have not had a raise. Now, I've got nothing against rich people. In fact, I like them. They allow me to have a business. But rich people save money and invest money. They don't consume the marginal dollar that the median household and the households below the median do. And if all the money in the economy goes to the wealthy, the recovery will be slower because there'll be more capital formation and less spending on consumer goods, including consumer durables and new homes and things like that. The disproportionate share of income that's gone to the wealthy in the American economy is unhealthy for the economy itself and is unsustainable in the long run. That's the fourth reason the recovery has been slow. And finally, the fifth reason the recovery has been slow has to do with what has been called in the movies failure to launch, what has been called by some prolonged adolescence, and what others know as the adult children living in the basement. If you look at the chart on the top of page 8, this shows you the rate of new household formation in the American economy. And what you see is it hits 0 in January 13. There's no growth in new households. Why is this? It ties into all the other reasons in this presentation. Young people can't find jobs. If they can find jobs, they're part-time jobs or they're low-wage jobs. Banks are unwilling to lend and consumers are unwilling to put on new debt, and as a result, they do not form households. And when they don't form households, well, you know what happens. They're using your carpets and your draperies and your TV and your furniture and your house. They're not doing all the things that go along with new household formation. So that's the 5 reasons why the recovery has been slow in the United States. Now, at the same time that's been going on, a weird and wonderful thing if you're an investor has been going on. Corporations are making record profits. How can it be that if the recovery is slow and consumers are having a hard time and the median household is making 20% less now than it did before the recession, how is it that corporate profits can be at an all-time high? Look at the graph on the top of page 9, and you will see that corporate profits are now taking up about 12.5% of the total US economy. This graph only goes back to 2000, but I can tell you, you can run that graph back to 1900 and you won't find a higher number than 12.5%. This is a record high for corporate profits. And transposed on that graph is the statistic we had before, that wages and salaries are commanding a smaller and smaller percentage of the economy. That's the red line. So as wages have gone down, corporate profits have gone up. Another reason corporate profits have gone up is shown on the bottom of the page. The American corporate lobbying effort has been enormously successful. Look at the percentage of tax revenue in the United States coming from corporate taxes. After the war, 6%, currently just over 1%. It's fair to say that the American polity has been captured by the American corporation to the great success of those corporations. And as investors, of course, we enjoy that. The companies in which we invest pay less tax, and we therefore get higher dividends and higher growth rates. But there you go. If you flip the page, you'll see another reason why corporate profits are at record highs, and it has to do with outsourcing. Now, this graph shows jobs which have been created in subsidiaries of American companies outside of the United States. And you can see, by the way, that Canada is one of the major beneficiaries of this. 1.1 million jobs have been formed in Canada between 1999 and 2009 by American companies. 1 million jobs in Mexico, 1 million jobs roughly in China, and so forth. American companies have found it profitable to move plants and operations outside of the United States to take advantage of different conditions, be they tax breaks in places like Ireland or Singapore, or lower wages in places like Mexico or China. And this has been very successful for them and has led to the biggest buildup of corporate cash in history. Right now, if you look at the graph at the bottom of page 10, you'll see that American companies, about 9 months ago at the end of 2013, were sitting on just under 2 trillion, that's trillion with a T, that's 1,000 billion, $2,000 billion of cash on their balance sheets. Now that's money that could be used for lots of things. You could build factories with it and employ people. You could do lots of things. What companies are mostly doing is using it to increase their dividends and buy back their shares. If you look at the graph on the top of page 11, and particularly in the sort of pink circle, what you will see is that US corporate buybacks are at a record level. All that cash is being used to buy back shares. Now, from our point of view as investors, that's a good thing. Why is it a good thing? Well, simply put, say you're Apple and you make $10 and you have 10 shares outstanding. Each share has $1 a share of earnings. But if you buy back 2 of your shares, now there's only 8 shares outstanding and your earnings per share are now $1.25 a share. It boosts earnings, which again, for us as investors, is really good news. But not necessarily good news for the economy in the long run, because no capacity is being built. And American industrial plants are the oldest they've been since the 1930s, because there hasn't been much reinvestment. But again, as investors, not a bad thing. And one of the most interesting things that's going on is a lot of these share buybacks are not only using this huge amount of cash that's built up on the balance sheet, it's also using borrowed money. Why? Because corporations can borrow money for almost nothing. American corporations can borrow money for 10 years for about 2.5%. And it's tax deductible. So the real cost of borrowing money is about 1%. Why not borrow money, use it to buy back shares, the earnings per share goes up, the share price goes up, and everybody's happy, including us. So that's one of the things that's happening. And I just want to say 2 more things about this phenomenon, because I think it's quite interesting. If you look at the graph on the top of page 12, this is a graph that shows productivity, which is basically a measure of output per hour of labor or other inputs. You can see that productivity, the dark blue line, has increased in a fairly steady fashion in the entire post-war period. But what you will also see is that in the last 30 or 40 years, the fruits of that increase in productivity have not been evenly shared between labor and corporations. In fact, you can see, 3rd time we've now had this graph, Real median income has been static even as productivity has gone up. That's why corporate profits have risen to a record level as a share of the economy. They're captured, basically all of that increase in productivity in the last 30 years has been captured by corporate profits, not by wages and labor. And one of the reasons for that you might conjecture has to do with the final graph in this section on the bottom of page 12, which has to do with the percentage of unionization in the American economy. After the New Deal and the Labor Relations Act brought in by FDR in 1935, the percentage of unionized employees in the United States rose very rapidly to a peak in 1945 of 35.5%. And since that time, that percentage has fallen steadily. And now, in the private sector, people who don't work for the government, 6.7% of workers in the United States are unionized. The most unionized sector in the United States is the government, as is the case in Canada. This is not a recommendation for or against unions, it's an observation. It's not prescriptive, it's descriptive. It may explain to a certain extent why it is that while productivity has gone up, wages have stayed static. It's a fact, not a request for change or a prescription in any way. It's just the way it is. So there you have it. US corporations doing really well, US consumers not so well, and the combination, a slowly improving economy in the United States, nothing like capacity. It's thought that an economy coming out of a recession in a recovery should grow at something like 4 or 4.5 or even 5% a year. What we've seen in the United States is more like 2.5% a year, a very slow recovery, maybe 4% in this particular quarter, helped by falling petroleum prices. Here's a good fact for you. Every penny that gasoline at retail goes down puts $1 billion in the pockets of American consumers. Isn't that great? Gasoline goes down 50 cents. That's $50 billion to spend on other things. We haven't seen the impact of that yet, but it's forecast that we will see that in the fourth quarter this year and going into next year. It could be a tremendous spur to growth in consumer spending. Now I want to talk about Canada. Canada, as you know, did not suffer in the recession anything like the Americans did. And in particular, our employment situation was and is much better. If you look at the graph on the top of page 13, which separates our economy by age cohorts, what you can see is that key age cohort didn't lose many jobs during the recession, and more people in those age cohorts are working today than were working before the recession. The only cohort that's been damaged, particularly in Canada, are the young and particularly the undereducated young. And if you look at the red line at the bottom, these are people 15 to 19 years old, primarily, and if you think about the fact that they're in the labor force, these are people with high school or less than high school, and you can see that employment prospects for that age group has been dismal. And many employers, even for what are considered to be relatively low skill or menial jobs, now demand high school education or better, and the prospects for that age cohort accordingly are quite weak. Canadian GDP, like the American GDP, has been growing, but growing fitfully. If you look at the graph on the bottom of page 13, the blue lines, positive growth, and these are monthly. Rarely do we see growth in Canada at more than 0.4 or 0.3% a month, equivalent to 3.5 or 4% a year. The Canadian economy has reflected the American economy and has been growing slowly, under potential for sure. And there's a reason for that too. If you flip the page, I want to tell you one of the things that I've become most concerned about in the last 2 months. The graph at the top of this page, at the top of page 14, shows you Canada's exports. The light blue line, the orange line, and the green line are natural resources being exported. And you can see it's about $103 billion, mostly energy, but also things like copper and coal and zinc and iron and lead and forest products. We export $103 billion worth of that stuff a year, and we import $107 billion of mostly finished goods. Now, those of you who are historians or interested in economic history will remember that one of the causes of the American Revolution 250 years ago was the mercantilist system, where Britain would export finished goods to the colonies and import low-value raw materials, particularly in those days, cotton and timber. Canada is 250 years later reflecting the same experience. If you look at this, look at that. We're hewers of wood and drawers of coal and bitumen. $103 million of natural resources going mostly south. 70% of our exports go south. And $106 billion of finished goods coming from the rest of the world. Now, the reason this graph worries me, when oil goes from $100 a barrel to $80 a barrel, you can assume that that $100 billion of exports is going to go to $80 billion of exports. And when iron ore drops like a rock, an iron rock, and when coal drops in value because China is making less steel, that also impacts our ability to export these natural resources. Canada's trade balance was positive in the last quarter. That's the graph at the bottom of the page. I can tell you that at $80 oil, Canada's trade balance is going to go sharply negative. And this is one reason, when we talk about the value of the Canadian dollar later, that I'm not particularly optimistic about the value of the Canadian dollar. Bright spot in Canada has been construction, particularly construction of new homes. If you look at the graph on page 15, you can see that the construction of new homes in Canada, unlike the United States, never took a pause. We did not fall off a cliff here. We had a little blip in the recession, but we're now constructing more homes now than we were before the recession. One of the bright spots in the Canadian economy. But it comes with a dark side. Unlike the American consumers, our consumers have been merrily piling on the debt. And if you look at the graph on the bottom of page 15, the blue line is Canada, the red line is the United States. While the Americans have been saving and paying off debts, the ratio of debt to household income in Canada is at an all-time high. And you can see that the American debt to income is about 1 to 1. In Canada, it's 1.6 to 1. And when you see agencies like Moody's, the debt rating agency, worrying about Canadian housing industry and Canadian household debt, this is why. So I'm now going to talk about everybody's favorite subject, real estate prices. There's a misconception about real estate prices in Canada. People say, house prices have gone up much too far, much too fast, they're unsustainable, we're in a bubble. And if you look at only the last 10 years, that appears to be the case. Look at the blue line on the top of page 16. And what you can see is that house prices in real terms, that is after inflation in Canada, really have doubled in 10 years. But if you then go further back on the graph, what you will see is that prices in 2004 were identical to prices in 1974, 30 years earlier. In other words, there was 30 years in which real estate prices in Canada didn't budge at all. So while it's true that house prices have doubled in 10 years, it's also true that they've doubled in 40 years, which sounds a good deal less scary. If you tell somebody, house prices in Canada have doubled in 40 years, they would say, well, that's not very much, is it? And they're right. We played catch-up in the last 10 years because we had 30 years of no growth in real estate prices. But there's another factor here. If people's income had risen in the last 10 years as fast as real estate prices, there'd be little reason to worry. But we know that's not the case. If you look at the graph on the bottom of the page, what you will see is the pinkish line at the bottom is family income. The red line is house prices. The ratio of house prices to family income has skyrocketed. In other words, the availability or the affordability of houses has changed in a fundamental way, but it hasn't caused new home construction to stop, and we know why that is. When I bought my first house in 1980, I managed to get a mortgage at 12.75%. And the only reason it was that cheap is because I worked for the Bank of Montreal and they gave me a concessionary rate. 12.75% is about 4 times as much as today's young family is paying on a new mortgage, which is available at under 3%. And accordingly, they can pay 4 times as much for a home as I paid in 1980 and have the same carrying costs. Well, the answer to that, which one always hears, is yes, but what about when interest rates go up? And the young family with the 3% mortgage is suddenly faced with a 6 or an 8% mortgage, and they'll default on their houses, and the bubble will burst, and real estate prices will go to zero, and we'll all go to hell. Well, first of all, interest rates aren't going up to 6 or 8% quite so fast. If they do, it'll be over an extended period of time. And my belief is that things will work out in that time period. So that's the description of the macroeconomy. I now want to talk about what do we do about all this as investors. If we believe all this to be true, what does it mean? Well, if you change to page 17, our asset class expectations, number 1, bonds, interest rates, what about those? We know for a certainty that interest rates are not going to rise in Canada for at least 18 months because the Bank of Canada has promised us so. And we believe they will not rise in the United States for at least 12 months and probably 18 months. And we know for a certainty they're not going to rise in Europe for at least 12 or 18 months. And in fact, rates in Europe may be coming down. Fixed income buying bonds is only as a defensive asset class to safeguard against disruptions in the markets, to provide a low but steady source of income. And for us, preferred shares are a much better asset than bonds themselves. Many of you will know that in your portfolios, you've been seeing purchase of preferred shares. These are paying dividends of around 4% to 4 1/3 or 4 1/4%. If they're in a taxable account, they're have the availability of the dividend tax credit, so they're producing 3% after tax. Bonds, you're lucky to get 1% after tax. It's an unrewarding asset category. We don't think it's going to change very much in 2015. We're going to de-emphasize it. Luckily, inflation is also very damped. We don't think inflation is going to be more than about 1.5% in Canada or the United States this year. So if you're making 3%, at least you're making a real return. If you're buying bonds after taxes and inflation, our belief is it's almost impossible to make a real return in today's market. So we're not buying a lot of them. Currencies, always difficult to project. Last year I said I thought the Canadian dollar would average around 94 cents. I was a little too optimistic. It averaged about 91 cents or 91.5 cents, I think, in 2014. This year I'm going the other way. I'm saying the Canadian dollar is likely to go down to 85 cents, possibly lower, and that's going to depend a lot on the prices for oil and other raw materials. If oil goes down to $60 a barrel and China doesn't buy coal and iron ore and copper, entirely possible for the Canadian dollar to go down to 82 cents, and nobody would be very surprised. The euro is currently falling against the United States dollar because the Eurozone is faced with the real possibility of recession as growth in Germany slows, and also with the possibility of deflation as the European central banks have been unable to increase inflation in Europe. So we could see the euro fall, I've said here, to about $1.15. Some people have said it might fall to parity with the US dollar. I don't think so. And finally, the Japanese yen is now at a one-year low against the US dollar, but I think it'll stabilize there. I'm now going to say my final few words before introducing my partner and our Chief Investment Officer, Barry Schwartz, who's going to talk about how we pick stocks. So I said at the very start that our downside capture had been exceptional. The reason for that is that your portfolios don't reflect the Toronto Stock Exchange. If you look at this big pie graph in the middle of page 19, you can see that oil and gas is 27% of the Toronto Stock Exchange, that basic materials, which is basically minerals, are 9.5% of the Toronto Stock Exchange. Nobody in this room has in their Baskin Wealth Managed portfolio more than 3% exposure to the oil industry. Nobody in this room owns any metal stock, precious, base, or otherwise. We do not reflect the Toronto Stock Exchange. So what has happened to the Toronto Stock Exchange doesn't have a one-for-one impact on our clients. And the reason for that is our methodology on picking stocks. So if you look below the pie graph, there's 5 things that we focus on. We want to buy stocks in a sector which grow even in a slowly growing economy such as we've experienced. We like to buy unloved, underfollowed companies. We like companies with compelling valuations based on fundamental analysis. We like companies that have a moat around them, that are hard to enter for various reasons. So no competitors, no new competitors. And we like companies which sell goods and services that consumers want and need. So that means that we don't buy the companies in the last paragraph. We don't buy commodity companies. They're what we call price takers. If you're producing iron ore or coal or copper or fertilizer, it doesn't matter if your fertilizer is better than the next guy or your coal is better than the next guy, you're still a price taker and there's nothing you can do about it. We don't like companies that are grossly overvalued based on fundamental analysis. We just don't buy them. We don't like companies that have a big geographical risk, like Russia, for example. So we don't buy them. And we don't like companies that are overly reliant on fashion or style or trends. Remember Crocs, those particularly ugly shoes? That stock went up like a rocket, and then it went down like a rocket. We don't like rockets. So I'm now going to ask Barry to come up and give you some examples of companies that we have bought, which may be in your portfolios.
Before I talk about companies that we like to buy for your portfolios, I just want to give everybody some insight into how we pick stocks for your portfolio. Reading, screening, and cloning. Sounds like a medical procedure, but that's really what we do every day. We do a lot of reading. We read analyst reports, newspaper articles, blogs, you name it, read them on the weekends, back and forth to each other, and we're looking for new ideas, we're looking for insights about the companies that we own. You never know what you can find about reading, and if anybody has trouble sleeping, I have some wonderful investment books that I can recommend for you. Screening is another great way of finding investment ideas. It's really essentially crunching the numbers to find companies trading at discounts to their price-earnings ratio, companies that have dividend growth over time, companies that have great balance sheets. It's a good way to compile a list of companies that we want to spend time to research more and find out insights about them. The final way is cloning, and cloning is really finding out what other great investors own and trying to mimic their investment style. So we always like to look at what Warren Buffett is owning, although I don't think Warren Buffett's having a very good week this week. But we like to buy companies that great investors come up with, and we look at their insights and try and understand why they bought or sold that investment. And there's nothing wrong with copying in our business as long as you understand and do your own homework. So that's really how we spend our time to try and come up with great ideas for your portfolio. So I want to draw your attention to page 20 so we can review some of the investment ideas that we like right now. As David mentioned before, there are 5 criteria that we look for when it comes for investment opportunities. The first investment that I want to talk about is Zimmer Holdings. Zimmer is the second largest orthopedic manufacturer of hips, knees, and dental implants. And if you look at the chart on page 20, you can see that because we're all living longer and the growth of the baby boomers, that people are wearing out their useful parts. I think I spoke to about 5 clients before this, and people were telling me that they're getting their hips or knees replaced. So you can see it's a booming, unfortunate business. What's going on with Zimmer is that we believe that there will be 6% compound growth for the demand in knees and hips over the next 10 years. So Zimmer is an investment that we believe can grow in a slack economy. Meanwhile, Zimmer trades at a reasonable valuation to earning, generates a lot of dividends, and has been buying back its stock. Let's move on to another idea on page 21, and that's Highliner Foods. Highliner is an example of an unloved and underfollowed company. We found Highliner by doing a stock screen, and one of the criteria we're looking for is company that are trading at cheap valuations and have dividend growth potential. So what comes to mind when you think of Highliner Foods? Fish sticks, that's right. Well, you'd be surprised to know that Highliner generates $1 billion by selling frozen seafoods, mainly to restaurants. So although they do fish sticks, most of their business is selling fish to restaurants. Meanwhile, if you look at the chart on page 21, you can see why Highliner is one of our biggest positions. The PE ratio, or basically the value of Highliner, is at 13 times next year's earnings, whereas an average of other food processing companies is close to 24 times earnings. So we believe Highliner is trading at a 60% discount to its peers. So we're going to keep buying this stock. Meanwhile, Highliner has raised its dividend every year since 2007 and offers a 2% dividend yield. Our next investment idea on page 23 probably is going to make you think we're out of our minds, is General Motors. So unfortunately, General Motors has been in the headlines as they are responsible for close to 30 deaths, faulty engine parts, as well as recalling 30 million cars this year. Now, you should keep in mind that GM sells about 3 million cars a year in the US. So that's 10 years of recalls per car sold. So why in the world would we recommend this stock to our clients and continue to buy it? Because GM is an idea that has it trading at a compelling valuation to earnings. In fact, GM is the cheapest stock that we own for our clients based on forward earnings growth. Now, ordinarily, we suggest when someone yells fire that you run. But when someone yells fire about a cheap valuation stock, it's always best to pull out your calculator, crunch the numbers, and then decide what to do. And that's what we're doing with GM. We've crunched the numbers, and it's extremely attractive. If you look at the chart on page 22, you can see that for some reason, people are buying GM cars, even with these nasty headlines. In fact, in September, car sales for GM in North America were up 17% year over year, and car sales for GM in China were up 15% year over year. Clearly, someone's buying these cars. GM offers a 4% dividend yield at these levels, and we think GM's going to raise its dividend next year. So we're going to stick with it. If you look at page 23, this is our investment idea that has significant barriers to entry to new competitors, and that's Cineplex. 2 weeks ago, my wife and I took our boys to see a movie, and I think we spent more money on the popcorn and junk food than we did on the admissions. And if you take a look at the chart, you can see how much money people are spending on junk food. Cineplex makes 80% profit margins on the junk food. Unbelievable. That's better margins than Google, better margins than Apple, better margins than Microsoft selling popcorn. And if you look at through 2008 recession, people were going to the movies and spending money on popcorn and junk food. So Cineplex is one of our favorite investment ideas. It's one of our largest holdings. It offers close to a 4% dividend yield. And the reason why it has such strong barriers to entry is there are really no other major cinema producers in Canada. Cineplex screens close to 90% of all first-run movies in Canada. And because of the smart management and real estate locations, there's no opportunities for any new entrants to come in. So while there's worries about Netflix and people getting better movies at home, clearly people are going to the movies, and 2015 looks to be a terrific movie year for Cineplex, as there are a number of superhero and Star Wars movies. Finally, investment idea is Visa. Visa is a company that actually sells a service. So notice that I said service, not product, because Visa is not a credit card company, it's a network company. Your credit card is actually issued by the banks. Every time you swipe your Visa or MasterCard, the merchants pay a toll to both the bank and Visa. So Visa is a network toll road company. And as the toll road grows, Visa continues to earn more and more income each and every year. In fact, trillions of dollars every year are spent using credit cards, and Visa gets a little tiny percentage of those trillions of dollars. But as people spend more money every year and the economy improves, Visa's earnings will continue to grow. If you take a look at the chart on page 24, you can see why we're so excited about Visa. Look at all the transactions right now going on in the world that are using cash. Although in North America, 50% of all transactions are with credit cards, and outside North America, 85% of all transactions are with cash. Lots of opportunity for the toll road to grow. And as people use their smartphone and do more shopping online, the only natural option is to pay with your Visa card or MasterCard. But we prefer Visa. So the Visa balance sheet is terrific. It's grown its dividend every year since going public in 2008, and has been buying back lots of stock.